I'm Yana. Welcome to my channel. In today's video, we're going to explore the different benefits, pros and cons of 4 popular investing options: index funds, mutual funds, ETFs, and bonds. By the end of this video, you'll have a clear understanding of which investment option may be right for you. So stick around until the end, and also please subscribe to my channel and give this video a like, as it really helps me with my channel. A survey shows that about 158 million Americans, or 61% of US adults, own stock, which is amazing, and the number has been up by 3% from 2021. It shows that more people are getting educated regarding the stock market and learning to take control of their financial future. Let's break down all these investing options so you can also feel confident and start your investing journey. I have included shortcuts for you in the description box below so you can skip to the parts you're more interested in. Let's start with the popular option, index funds. Index funds are a type of mutual fund that aim to match the performance of a specific market index like the S&P 500. The S&P 500 is like a big list of 500 of the most important companies in the United States. Think of index funds as a package of investments. It's like a bucket with different stocks instead of just one single stock. Here are some key points. Number 1 benefit is the diversification. Index funds offer diversification by tracking a specific market index such as the S&P 500. It reduces risk as your investment is spread across multiple companies, so you don't depend on performance of only one company. This helps make your money safer because if one company doesn't do well, it's okay because you have a little bit of many others. So you're not putting all your money in just one company, which would be riskier. It's like having different types of candies in your basket, so if you don't like one, you still have others to enjoy. Lower cost. They are known for low costs because they are passively managed, meaning there is no need for expensive professional stock pickers compared to actively managed mutual funds. For example, a popular choice is the Fidelity 500 index fund. Here, as you can see, the expense ratio is only 0.015%. So if you invest $1,000, you would annually pay only 15 cents. Let's now list the pros and cons of index funds. Transparency. This means that index funds are easy to understand. You know exactly what they're investing in because they follow a specific index like S&P 500. It's like following a recipe where you know all the ingredients. Liquidity. It's like how quickly you can turn something into cash. With index funds, you can sell your shares and get your money back quite easily because they're traded on the stock market, just like buying and selling items online. Simplicity. Index funds are straightforward. You don't need to worry about someone trying to pick the best stocks or bonds. They just copy the index, so it's like taking a simple path to invest. And for the cons, limited potential for outperformance. This means index funds won't make you super rich because they aim to do as well as the index they track. They won't try to beat it. It's like running a race where you're not trying to be the fastest, you're just keeping up with the leaders. Their primary aim is to provide investors with returns that closely mirror the overall performance of the market represented by that index. While this may seem as a limitation, the index funds are a great option for long-term investing, and low fees make it worth it, as when the fees are high, it makes a difference when your money is compounded over the years. Another con is that they also can be bought or sold until the end of each trading day. In summary, index funds are easy to understand, easy to sell, and they don't aim to be superstars. They follow the market without trying to beat it by a large margin. This can be a good option if you want a safe and reliable way to grow your money over time. Now let's move on to the mutual funds. Mutual funds are investment tools where your money is combined with that of other investors to purchase a diversified portfolio of stocks, bonds, or other securities. Mutual funds are a group of stocks. When you buy a share in a mutual fund, you get a tiny fraction of each stock in the fund, giving you better diversification. Benefit: professional management. They are actively managed by professional fund managers who make investment decisions to try and outperform the market. Pros: they can provide diversification same way as index funds, as we talked about it earlier. Compound interest. Investors can choose to have dividends and interest reinvested, which will then go to buy more shares of the mutual fund, enabling faster growth, earning interest on top of interest. Cons: higher costs. Because mutual funds are actively managed, they have expenses typically ranging between 0.5 to 1%, which pay for management and other costs to operate the fund. Risk: also, there's a potential for underperformance because even the professionals can't always predict the market performance by 100%, so there's no guaranteed returns. Over the 5-year period ending in June 2022, Very few actively managed funds routinely beat the market, according to the S&P Dow Jones indices. Tax inefficiency. Mutual funds pass along capital gain distributions to investors, which arise from the selling of securities at a profit, even if the investor didn't sell any shares. Investors also pay taxes on dividends and interest earned in the fund. Now let's talk about the exchange-traded funds, as known as ETFs. ETFs' popularity has grown tremendously in recent years. The data from Morningstar shows US ETF market valuation has grown to over $7.3 trillion at the end of 2021. Like mutual funds, ETFs are made up of pools of securities. They can track various assets including stocks, bonds, commodities, and more. ETFs are similar to mutual funds, but are traded on stock market exchange like individual stocks, meaning they can be bought or sold at any time. You don't have to wait for the market to close. This feature offers the investor the ability to buy or sell throughout the day, to take advantage of market opportunities versus waiting until the end of the day as with mutual funds or index funds. Let's list the pros and cons. Let's start with pros. ETFs are generally considered more tax efficient than mutual funds due to their unique structure that results in fewer capital gains distributions than mutual funds. Intraday trading. ETFs trade on stock exchanges like individual stocks, providing liquidity and the ability to trade throughout the day. Market access. ETFs provide access to a broad range of markets and sectors, including international markets, industries, and niche segments that may be challenging to access for individual investors. Short selling. Investors can use ETFs for short selling strategies to profit from declining markets. Now let's talk about the cons. Potential tracking error. ETF managers are supposed to keep their fund's investment performance in line with the indexes they track. But there are many ways an ETF can stray from its intended index, and that can cost to investors. In simple language, it means that an ETF, which is like a collection of investments, might not follow a target as closely as you'd expect. Think of it like following a friend who is riding a bicycle. If you're walking behind them, you might not stay behind them the whole time. You might get a little ahead or fall behind due to small bumps in the road. Similarly, ETFs may not exactly match the performance of the investment they are trying to follow because of cost and unpredictable ups and downs in the market. This difference between the ETF's performance and the target is called the tracking error. Expense ratios. While ETFs are often known for the low-cost expenses compared to mutual funds, they still have expense ratios. These expenses can eat into your returns over time, especially if you're holding the ETF for an extended period. Overtrading. The ease of buying and selling ETFs can tempt investors to buy and sell ETFs too often. Imagine if you kept buying and selling your gadgets every day. This can be a problem because each time you do this, it can cost you money like a fee you have to pay. Also, when you sell things, you might have to pay some taxes. And if you keep doing it too much, you could end up owing more in taxes. So it's better not to buy and sell too much, just like you don't want to change your gadgets all the time. And lastly, let's talk about bonds. Bonds are like loans that you give to a company or government. When you buy a bond, you're lending your money to a company or government, and in return they promise to pay back the money you lent them, plus a little extra interest after a certain amount of time. It's kind of like giving your friend money and they promise to get it back to you with a little extra as a thank you for lending it to them. Bonds are considered a more conservative investment, providing income and relative stability, but with lower potential returns compared to stocks. Let's list the pros. Steady returns. Bonds provide a predictable stream of income through regular interest payments. Safety. Bonds are generally considered safer than stocks because you're lending your money to an organization or government, and they promise to pay it back. Diversification. Bonds can be a part of a diversified investment portfolio, helping spread risk. Preservation of capital. If you hold a bond until it matures, you usually get back the money you initially invested. Cons of bonds. Lower earnings. Bonds usually don't make as much money as some other investments like stocks. The amount you earn is often fixed. Interest rate risk. If interest rates go up, the value of your bonds might go down, which could lead to losing money if you sell before they are due. Inflation risk. Over time, the money you get from bonds may not buy as much because of rising prices. Not so quick to buy or sell. Bonds can be turned into cash as quickly as some other investments, which can be a problem if you need money right away. Risk of not getting paid back. There is a small chance that the group you lend money might not be able to pay you back. This is called credit risk. And lastly, missed opportunities. While your money is in bonds, you might miss chance to make more money with other investments. That's why you shouldn't put all your money in bonds, but keep them as a part of your investment portfolio to mitigate risk. Let's sum up this and then talk about which investment option is right for you. Index funds, ideal for long-term investors seeking broad market exposure with low costs. Mutual funds, suited for those who prefer professional management and are willing to pay higher fees. ETFs, best for active traders or investors seeking intraday liquidity and low costs. Bonds, a good choice for income-oriented investors looking for low risk and stability. So which investment option is right for you? It depends on your financial goals, risk tolerance, and time horizon. You can approach your asset allocation according to your age. Here are some great suggestions. You can consider investing heavily in stocks, meaning index funds, mutual funds, ETFs, if you're younger than 50, and saving for retirement. You have a long time until you retire, so you can handle any ups and downs in the market. As you reach your 50s, consider allocating 60% of your portfolio to stocks and 40% to bonds. Adjust those numbers according to your risk tolerance. Once you're retired, you may prefer a more conservative allocation, 50% in stocks and 15% in bonds. Again, adjust this ratio based on your risk tolerance. I hope this was helpful and you have a better understanding of investing options. This was the part 3 of investing series for beginners, and if you haven't watched the first 2, go ahead and watch them, and I'm gonna link them in the description below. Please comment down below what you think about these investing options, what's your preference, as I'm very curious to know. Also, please subscribe to my channel and give this video a like for the Google algorithm. Thanks for watching!